Uber announced that it will acquire food delivery app Postmates for $2.65 billion in stock, expecting the deal to close in the first quarter of 2021, according to the Wall Street Journal. There are 3 reasons this is a bad deal. I have no financial interest in the securities mentioned in this post. Food delivery is a money loser. The market for food delivery is big and growing, but it has severe profit pressures. Having grown at 13% a year in the 5 years ending 2019, food delivery is expected to grow at a 31% annual rate to $467 billion by 2025, according to CNBC. Sadly, smaller average check sizes, fierce competition, and better price comparison information make food delivery a thin-margin business. As CNBC wrote, the growth of the average check has fallen sharply from more than 4% in 2015 to zero growth in 2019. Aggregator sites such as FoodBoss allow users to compare the price and speed of digital delivery services among the restaurant they choose. What's more, rivals such as Grubhub, DoorDash, Uber Eats and Postmates are fighting fiercely for market share. In 2019, DoorDash, which grew a whopping 143% in 2019, led with 33% share, Grubhub was close behind with 32%, Uber Eats 20%, and Postmates 10% were the 2 laggards, noted CNBC. If that's not bad enough, money-burning restaurants are desperately trying to cut spending, and they are putting pressure on these delivery services to cut their fees. Combined companies will not be better off. Uber, which will issue 84 million shares of common stock for 100% of Postmates' fully diluted equity, is bullish on the deal. CEO Dara Khosrowshahi said July 6 that said Uber Eats' second quarter bookings more than doubled from the previous year. In May, he said Uber Eats' gross bookings rose 52% in the first quarter to $4.68 billion. According to the journal, companies have offered steep discounts to get consumers to try out their food delivery services. That is reflected in Uber Eats' high cash burn rate. Its segment-adjusted EBITDA was negative $313 million for the first quarter, meaning Uber burned 59 cents worth of this segment-adjusted EBITDA for every dollar of Uber Eats' adjusted net revenue, according to its first quarter 2020 report. Postmates had filed for an initial public offering, according to the New York Times NYT. But its financial condition is unclear. According to a September 2019 Restaurant Dive article, Postmates generated $400 million in 2018 revenue and was unprofitable. In June, Dutch food delivery giant Just Eat NV paid $7.3 billion for Grubhub, with its 32% market share. Since Postmates' market share is 10%, it would be worth no more than $2.3 billion. I estimate Postmates should garner 31% of Grubhub's price. So Uber is overpaying by at least $350 million for Postmates, which decided it would be better off betting on Uber stock, which trades 23% below its May 2019 IPO price, than going it alone in the IPO market.